Hey guys, welcome back to the TFSA challenge where I'm taking a $2,000 portfolio and trying to grow it to $50,000 in 3 years. Every single week, I'm depositing $200 into this portfolio. So if I didn't get any gains in this portfolio and just relied on that $200 deposit, I would end up with $33,000 after 3 years. So I need to find a way to increase my account by $17,000 of realized gain in the stock market. Currently, we're on week 39 right now, and my portfolio is worth $10,000 or just shy of $10,000. And today in this video, I'm going to be sharing with you guys the 5 stocks that I bought this past week. If you guys are interested in Canadian stock market content, then be sure to subscribe down below. And later on this week, I'm going to be talking about 2 growth stocks in the payment space that recently got hit hard and dissecting what's going on in there and if I see any value in buying into these stocks, maybe even for this portfolio. If you've been watching this series for a while, or this is your first time and you're inspired to start investing today, then I've got a special offer for you down below in the description. You can sign up for Wealthsimple Trade today, deposit $150 and start trading, and they'll give you $50 extra. So instantly your portfolio will grow from $150 to $200, meaning a 33% gain. Today we're going to make it quick and fast and just go over all the stocks that I bought, and we're going to go over to my computer and check out that spreadsheet. So as always, we start off in the portfolio metrics. The total market value for this portfolio is $9,885.93. Currently comparing my portfolio against the index, if I were to have bought the ETF version of the index rather than all these individual stocks, my portfolio is down by 3.66%. Or in dollar figures, that's $375.78. If you guys are interested in making a spreadsheet similar to this, I've got a Skillshare course that's completely free if you use a free trial. You have 14 days to watch the entire course, and it's not too long to watch. I just go over basically a tutorial of how I do the spreadsheet. You can find the link down below. Jumping over to the transactions tab, I've highlighted all the stocks that I bought this past week. So I deposited $200 as usual, and the stocks that I bought were Shopify, Well Health, National Bank of Canada, D2L, and Air Canada. I also received a dividend of $1.84 from RioCan. So talking about Shopify, because this is the first stock that I bought this past week, I've noticed that Shopify, if we pull up this chart over here, Shopify has dropped in the past month or so. So its highs were sitting around $2,100 and it's fallen about 13%. And if you guys have been watching this series for a while, you know that I've been buying Shopify in like the $1,700-$1,800 range. So for me, Shopify, this position here is definitely a long-term hold. I truly believe that the company is changing the landscape of e-commerce and giving it an alternative to Amazon. So Shopify, if we go to my portfolio, has been building up its position. Every single time I buy Shopify, I usually buy $25 to $35. And at first it started out as like a very low position, but currently I've put in about $400 ever since starting this position. And you can bet that if Shopify this week dips below $1,800 into the $1,700 mark, that's where my cost per share is, I will be buying more of Shopify. Now, Well Health Technologies is another stock that I've been talking about quite a bit on this channel, not just in this TFSA portfolio, but earlier in 2021 as well as 2020. This stock and company I truly do believe in for the long term. This company, they continue to release a lot of good news. They provide updates on organic growth in its US-based business. They also had some pretty major growth in their financial results, which they released last month. They participate in investor conferences, and they also announced an inclusion into the S&P/TSX Composite Index. They have a lot of great news coming out from their own press releases. However, what you must know in the stock market is that to be marketed by other news outlets is very important as well, because that's always a nudge to investors of like, hey, I'm a company, I actually exist over here, check me out and see what's going on in my business. So if there's not enough press coverage from exterior news outlets, then that's why we can see a stock continue to fall, because the investors who are currently in Well Health, of course they know about it. But those who have sold their stock in Well Health or just never knew about the company, most likely they're not coming back interested because they don't get notifications from the news outlets that they're reading. And they're not going to go to Well Health's site to actually look at the investor relations page and see what's going on, unless they do believe in the business for long term. And if they do, they're already shareholders, just like I am. If we go over to a chart of Well Health Technology stock, you can see that they peaked around $9 on this one day here, but that didn't stick along for very long. And right now we're on a fairly drastic downtrend, almost like a falling knife, which is concerning to investors, that's for sure. So I don't think this falling knife action is really representative of Wellhealth's business. It's just the way that the market is working right now. People see the stock dropping like a falling knife and they sell because they're like, I don't know how far it's going to drop. And it could drop all the way back down to the $1 level because that's where we saw the last support. We saw a meteoric rise here and not much support there. Maybe you could say some support levels are at the 250 or so, but beyond that, we don't really have any support from the $3 to $5 range. So as a Wellhealth shareholder, yes, it's a little bit concerning for the short term, but because this portfolio of mine here is at least a 3-year portfolio, I'm not going to be gaming the market and I'm just going to keep buying the dip on this stock. I covered why I'm buying National Bank, and this is the first week I started buying into the stock. So if you want to see why I'm buying National Bank instead of the other 6 banks, I've got a video in the top right over here for you to check out. D2L, I also have another video on where I did a deep dive analysis into that company before or just after it IPO'd. So if you're interested in why I'm buying D2L, then you should check that video out as well, and I'll have that linked in the description. In Air Canada, this is a stock that's been hit by the pandemic left, right, and center. At one point it was coming back because people thought things were going to open up. However, with a new variant in town right now, I think that people are bearish on Air Canada, and we're just going to see that sort of action go back and forth as long as COVID stays around. But my theory with Air Canada is that once this whole pandemic is over, Air Canada should be able to recover because its management team in the past has shown it's able to take an airline business, which is traditionally not very profitable, and make it a profitable company. So as a long-term investor, Air Canada kind of makes sense to me right now because it's trading fairly cheap to how it could be operating 3 or 5 years from now. But those who are in the stock market for only about a year or two and hoping to get gains in the matter of months, then Air Canada is not a play for you. Looking at the entire portfolio, just sorting the 1 week performance, this past week, the stocks that did the worst are Enghouse and D2L. D2L, I can sort of understand why it's not doing so well, just because of lack of press coverage. Not many people know about this company or what they do, and a lot of the investors who are into small cap technology stocks at the beginning of this year have now pretty much exited the market. So there isn't much of a buyer base for technology stocks right now. So D2L, I still think, is trading at a fairly cheap valuation compared to its competitors. Enghouse Systems has also been another stock that's been hit fairly heavily recently. And I think that's just due to the lack of revenue growth. Recently, they reported earnings, and the revenue growth, they actually had a revenue decline as well as a net income decline. And that's just due to one of their business units was thriving during the pandemic, especially in 2020, as people were not going into the office at all. However, now people are going back into the office slowly, and companies are being a bit more relaxed with COVID because they know what they're dealing with. People stopped subscribing to that service, and Enghouse's one business that did very well in 2020 didn't do so well in 2021. They do also pay a dividend yield of 1.26% right now. So while this stock is on the cheap, I'm also getting a 1.26% dividend. And this week, I will be buying some more stock of Enghouse because it's way below my cost basis of $57.16. I filtered my transactions here just for Enghouse, and you can see that when I started this portfolio, I already had 5 shares of Enghouse, and the cost basis was $61.87, which was the price of Enghouse the day that I started this portfolio. My actual cost basis for these 5 shares was lower than that, but just to be fair to this series, I wanted to take the day that I started this series as the cost basis. And ever since then, except for the first purchase that I made in this video series, I've been buying Enghouse at $55 or less. And I've also been collecting a dividend of $1, $1.44, $2.08, and more to come in the future. Stay tuned for next week when I reveal the new stocks that I'm buying this current week. I'm thinking of purchasing one new company in this portfolio, so let me know down below in the comments which company you think this is. I've got a couple videos on the screen for you guys to check out. If you're interested in those, I'll see you there. If not, keep up the grind and have a great day.